Lululemon.
I'm a hoe for Lululemon, so.
Lululemon.
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 Lululemon. Lulu.
This is probably all I wear when I'm not here on set, as I am wearing my Lululemon.
Welcome back everyone to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. I'm buying Lulu stock over Nike stock in 2024. Why Lululemon will chip away at Nike's growth. Both Nike and Lulu were down on Friday. Jeremy made it seem like Nike didn't go down. Give me a break, man. He didn't even listen to the conference call before making that video. Why Lululemon will overtake Nike to be the largest athletic brand. Lululemon may be known for clothing, yoga, but its share price movement sure don't inspire serenity. But as an investor, that's what we are waiting for, a discount. Or you can call it as volatility. If you go to a Lululemon store, you barely see any discount. But in the stock market, we can get Lululemon business at a discounted price. We see volatility as a blessing. Yes, Nvidia has no blessing for us right now, but Lulu does. Today we are going to compare Lulu with Nike in both financial metrics and in fundamentals to see how the yoga pants queen can dethrone the sneaker king. Why Lulu will decimate Nike in growth over this decade into the future, and why Nike is being disrupted by not just Lulu as we speak. Competition for Nike. It hasn't really had much in terms of competition until now. You're starting to see some of these newer younger brands like Hoka from Decker's brands. What we've got now, as we got all of these smaller rivals, but they are all nibbling away at various bits of Nike's business. You've got Lululemon doing that, nibbling away Nike's footwear business. Lululemon running shoes, which is growing significantly in gaining market shares, both taking market shares from Nike. Nike is more of a mass appeal apparel and footwear company. What Nike has done is it relied on these big sellers that burn very bright, and then they fade. The Air Force One, that is fading. My question is that, where is the growth going to come from? You know, the first thing you see on their investor website is Nike is a growth company. And I'm just not sure that's the case anymore. I listened to the Nike conference call. This is Cliff's notes. Look, we made a mistake. We focused on selling our products from our website and our own stores because we thought we drove the marketplace, but let our competitors step in and take market shares at the local shoe stores. It turns out their products aren't that bad and consumers like them. So we've got to focus on new product innovations and get back at the local shops. We have a 3-year plan to build a robust pipeline for each sports season after season of innovation. You will see athletes wear our Air technology, which is surely better than those cloud things, and we're putting them in lifestyle shoes too, which is cooler than any slipper-like shoes. We see soft revenue, but better margins for the rest of this fiscal year. We expect a decline in revenue during the first half of next fiscal year, with the subdued outlook around the world, but we will build brand strength and see growth in the second half of the year. Compare Nike with Lululemon. Lulu deserves a higher premium, and they are the better operator. Nike is more mass appeal, and they saturated a lot of their big markets. Though the US for them is saturated, Europe, they've got some room there to grow. In terms of soccer, for me, it's pretty much a no-brainer in terms of who deserves a higher multiple value. Because look at the growth rate of both businesses. Revenue growth, we can see Lulu has revenue growth on the average of 18% in recent quarters. When we look at Nike's growth, we are looking at a low single-digit growth in recent quarters. We can clearly tell Nike is growing significantly slower than Lulu for a long time. Let's look at gross margin and net profit margin. We can see Lulu has a gross margin above 55% consistently. The most recent quarter, it reached 59% gross margin, signaling its wide moat and the strong brand strength. We can see Nike has a gross margin of 44% consistently. It's not bad, kind of like Apple, but it's not as high as Lulu for the profit margin side. You can see Lulu has a profit margin on average of 15%, while Nike has an average of 11%. We can see based on the numbers, Nike is not as profitable as Lulu. What about return on invested capital? ROIC. This is one of the most important metrics. The higher, the better. ROIC shows investors how much profits the company's invested capital generates. It essentially shows them if the company is investing money wisely and getting solid returns from it. Charlie Munger said this famously, if a business earns 18% on capital over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a fine result. ROIC also removes the total cash position because uninvested cash is producing no returns. It's quite literally uninvested. ROIC also factors in the company's debt because a company taking on debt is a form of investment. Typically, companies will take on debt to fuel more growth or buy a new asset. Now you can see from this chart, Lululemon has always had higher ROIC than Nike, and as high as 59% most recently, while Nike is at 33%. Now we are looking at shareholders' equity, which is the book value of the company. We can see Lulu's book value per share going up rapidly in the most recent quarter. What does this mean? When a company's book value increases over time, it generally indicates that the company is growing its equity and improving its financial health. This can happen due to several reasons. Accumulation of earnings, retained earnings, which are profits not distributed as dividends, can increase equity. Asset appreciation is number 2. If the company's assets increase in value, this can raise the book value. And number 3, reduction of liabilities. Paying off the debt or other financial obligations can also increase book value. We can see Lulu's book value just consistently going up over the years, while Nike's book value is not that consistent. You can see from 2015 to 2019, the book value actually in decline for 4 years straight, which means Nike's debts are growing quicker than its assets. It is a red flag. It means the management is getting complacent. This is a point that I have to point out. When you go to Nike's corporate governance page, you see an empty Nike field. There is no action. And then you are greeted by their board of directors. You see Tim Cook, aged 62, and you are thinking, no wonder Apple hasn't put out any good AI products so far. Nike CEO is age 63. Chairman, age 67. Well, even though age is just a number, when it comes to growth factor and decision making, when you get older, you tend to be more comfortable and complacent, especially when you are making this kind of money for a salary. Nike CEO John Donahue was paid $32.8 million last year. His COO and CFO both are getting $10 million last year. Dang, if Nike pays me $10 million a year, I would really think about how I'm going to invest that money and less about how to grow the Nike's business as a CFO. Alright, let's look at how much Lulu CEO and CFO are paid. Lulu CEO Calvin McDonald, age 49, was paid $15 million, and CFO Megan Frank, age 44, was paid $3 million last year. Management is crucial, and if they are paid too much, it's less going to the shareholders. Lululemon has been rapidly growing and has several strategic advantages that could potentially allow it to challenge Nike's position as the largest athletic brand. Here are some reasons why Lululemon could take over Nike. Larger e-commerce business. Lululemon has a significant direct-to-consumer sales channel, which accounted for a considerable portion of its revenue. This is higher than Nike's digital sales mix, and as more transactions move online, Lululemon benefits from higher margins due to lower overhead costs. Lululemon's gross margin has consistently been higher than Nike's, partly because Lulu sells most of its products directly to customers at full prices, supporting a premium brand perception. Bigger international opportunity. Lululemon's expansion into international markets presents a significant growth opportunity. The brand has been expanding its global presence, which could contribute to increasing its market share. Lululemon is known for its product innovation, especially in the athleisure segment. Its focus on high-quality products and fit has helped it create a strong brand identity. Lululemon has been building brand loyalty through community engagement, such as in-store classes and running groups, which enhances customer retention and attracts new customers. Lululemon is expanding into new categories like menswear, golfing, hiking clothes, which broadens its market reach. I listened to the Lulu's earnings conference call. Here are my keynotes. We exceeded our updated guidance, but international is doing better than the US. We are in the early innings of our growth story, but with softness in the US consumers, we look for our competitors to pull back while we go on offense. However, international remains strong, especially for China. We remain excited about the potential for Lululemon in China. Q4 revenue increased 78% in mainland China, and we believe several factors benefit us in China. One, we are building from a smaller base. We have 127 stores on mainland at the end of the quarter, and we will see opportunities to continue to add. We have and take a localized approach to our brand, leveraging relationship locally in the community through ambassadors, instructors, and influencers that has really resonated. Locals in some of our most exciting activations come from that. Big influences Nike uses doesn't really relate to the regular wealthy people that shop Lulu's products. From a markdown perspective, Lulu runs a very low markdown rate. Generally speaking, 2023 was flat to 22 and 2019, which is a healthy waterline for us. That's Lulu's expectation for 2024. It's understandable that Lulu'd want to keep markdown low to maintain their profitability. Their strategy of running a low markdown rate and keeping it consistent with previous years seems prudent, especially if it aligns with historical data and has proven successful. Canada is continuing at strong momentum into quarter one, the sales per square foot metric being highest in the US. Suggests a robust retail performance for Lululemon. As for marketing, Lulu's campaigns are strategically designed to enhance unaided brand awareness, and we're seeing positive results from these efforts. The Cityverse activation and the focus on innovative product launches, such as the upcoming bra innovation, are exciting developments that should continue to drive interest and engagement. The collaboration with the Canadian Olympic Committee also seems to be a significant move to bolster the brand's global presence. These initiatives, aimed at increasing top-of-funnel awareness, are crucial for long-term brand growth and recognition. These factors, combined with Lululemon's agile business model and strong brand, position it well for potential growth. It's important to note that overtaking Nike means Lulu will have to triple its market cap, which means, as shareholders, 3x of our invested capital. It might be challenging, but I see it happening in the future.